In this video, I'm going to show you the journal entry for a stock issuance. And I'm going to show you how that journal entry would differ based on whether the company is issuing common or preferred stock, whether the stock has a par value, whether the stock's being exchanged for something other than cash, and how to deal with any stock issuance costs. So let's get started. We'll jump in with an example. Let's say that the company Tandem Toilet issues 100,000 no par common shares of stock in exchange for $800,000 cash. We'll assume that there are no stock issuance costs here. We'll deal with that issue later. Okay, the company is going to debit the cash account for $800,000 and they're going to credit the common stock account for $800,000. That's a very simple example. Now let's add a complication. Let's say that the stock does have a par value. Okay, if the stock has a par value of $2 a share, we're going to need to make a little adjustment over what we did before. So we're going to take this $2 a share and we're going to multiply it by the number of shares, which we said was 100,000. So $2 a share times 100,000 is going to give us 200,000. So now we're going to credit the common stock account, right? We're going to credit that by the par value times the number of shares being issued, which is 200,000. Now, we can't just say, well, let's debit cash for 800,000 and credit common stock for 200,000 because our debits and credits wouldn't balance. So we're going to have a credit of 600,000 in addition to the credit to common stock, and we're going to call that account additional paid-in capital. So we debit cash for 800,000, and then we credit common stock, and then we credit additional paid-in capital. Additional paid-in capital is the money we received above and beyond the par value per share. Now, what if that stock had instead been exchanged for something other than cash? What if the company didn't receive cash? What if they received land? How would we deal with that? Well, we're going to use the fair value of the non-cash consideration. Non-cash consideration is just the thing other than cash, right? So in this case, it's the land. The fair value of the land or the fair value of the stock, whichever is more readily determinable, okay? So if you know the fair value of one of these but not the other, use the one that you know the fair value of. So let's assume that we know the fair value of the land and that happens to be $800,000. Okay, we're going to debit the land account for $800,000. We're not debiting cash because we're not receiving any cash. We're going to credit the common stock account for $200,000. Again, that's just our par value per share times the number of shares issued. And then we're going to have our additional paid-in capital account as the plug. So we're debiting the land for $800,000. If we didn't know the value of the land, then we would use the fair value of the stock. Okay, so and then that would be whatever the amount we would debit the land. So if we said we have no idea what the land is worth, but we know what the stock is worth, then we would debit the land for that amount. Now, what if the company had instead issued preferred shares? Okay, we were talking about common shares in all these examples before, but what if they had issued 100,000 preferred shares of stock? Again, we'll assume that there's a $2 par value per share and that the company had received $800,000 cash. Okay, now in that case, we're going to debit the cash account for $800,000. We are going to credit, instead of crediting common stock, we're going to credit preferred stock, and we're going to credit preferred stock for the par value times the number of shares. So 100,000 shares times $2 par per share. We're going to credit common stock for $200,000, and then we are going to credit additional paid-in capital preferred stock for $600,000 so that our debits and our credits balance. Now, in all these examples, we have ignored stock issuance costs, okay? Stock issuance costs. So what are stock issuance costs? Well, when a company does a stock issuance, they might pay an underwriter to handle the stock issuance for them. They might hire an investment bank. Okay, so they pay fees to the underwriters. They might have lawyers, accountants involved that help them with this stock issuance. Okay, now, if these costs are directly attributable to this stock offering, in other words, the company would not have incurred these costs but for this stock offering. They hired that investment bank to help them with this stock offering to raise money. Then those costs can be charged against the gross proceeds of the stock offering. So let's put that into an example here. So we'll assume the company issued 100,000 shares of stock. This is common stock, and we have a $2 par value per share. Okay, so 100,000 shares, $2 par value, and it's common stock, and they're receiving $800,000 cash, but also they were paying out $50,000 to the underwriters, to lawyers and stuff to handle this stock issuance. So what we're going to do, this whole thing here that I was talking about, you'd say, what did that even mean? Instead of debiting the cash account for $800,000, we're going to debit the cash account for $800,000 minus the $50,000 of stock issuance costs. So this is the $750,000. So that's the $800,000 minus the $50,000 of stock issuance costs. Okay, so they got $750,000. We know the common stock is being credited for $200,000. That's just our $2 par value times 100,000 shares, right? That's where we got that 200,000 from. And then debits are 750,000. So the credits need to be 750,000. So we already have a credit the common stock at 200,000. So we know that we are going to credit the additional paid-in capital account for $550,000, and we are done.